bit. So what's behind the gold rush, and how big a share of your portfolio should it claim? We'll talk to two of the heads of two big gold trading firms next.
You're watching Morning Call on CNBC.
Chinese bank officials say they are going to diversify their massive reserves, and gold goes crazy, leading to its biggest one-day increase in years. Gold traders think the statements, which came in Frankfurt yesterday, mean the Chinese will be buying even more of the precious metal. But gold's already up 23% this year, so is the speculation about China enough that you should buy now? Craig Smith is CEO of Swiss America Trading. He says China can send gold up dramatically. Frank Holmes is CEO of U.S. Global Investors. He says, no matter what you think, don't make gold more than 10% of your portfolio. Gentlemen, thanks for being here. Craig, let me start with you. What do you make of these comments from China, and what could it do to the price of gold if indeed they do start to shift around their money?
Well, I think China's just a portion of it, Michelle. I also think that you have money managers from oil-producing nations that have billions of fresh petrodollars that are looking for a home.
No, I agree. There are a number of factors, but I want to drill down to this one. How much gold do the Chinese own right now? And if they shift, how much could they buy?
Currently, their foreign reserves represent about 1.3% diversified into gold. They've been talking about a 2.4% holdings in gold. Now, that's in light of the European Central Bank holding 26% in reserve. The United States, 74%. I doubt that the Chinese will move that direction, but think about it. Just a 1% increase would put a huge demand on this market. And I agree with Frank. We quote him a lot at SwissAmerica.com that no more than 10% of your portfolio should be involved in gold.
We're going to get to Frank in a second, but let me talk about these numbers that you said. You said China has 1.3% right now reserved in gold. If they have $1 trillion worth of assets, that means $13 billion worth of gold. If they go to 2.4, that means $24 billion worth of gold. Frank, does this give you any reason to add to your portfolio right now when it comes to gold?
Well, presently we're looking at gold at about a $50 downside risk. We seem to get great demand over the Middle East, Chindia, I like to call China and India combined. However, over $700.
That's a new one, Chindia. I haven't heard that. Maybe that'll become part of the lexicon. All right, keep going.
And then over $700, there seems to be a slowdown in demand, and jewelry demand is very important. It's 70% of the equation for the demand side. So we look at gold where it is today. It has $50 on the downside. It has $100 on the upside over the next 12 months. So it's roughly a 2-to-1 ratio.
So am I hearing you correctly? The China thing doesn't necessarily impress you one way or the other?
We've been talking about China for a while, and the real more impressive part so far has been Russia, and that taking a portion of their oil revenue and diversifying into the euro and into gold. They've made these statements. This time last year was one of the catalysts for higher gold prices. It's been recirculated again. Oil's $60 a barrel range. They're making a lot of money, and they're diversifying with gold.
Yeah, Craig was talking about that
Michelle,
as well. Go ahead.
Michelle, this comes on the comments also a couple weeks ago of Alan Greenspan when he talked in front of the Commercial Finance Association meeting, talking about how there's a move out of dollars into euro now, and it's not just private investors, it's monetary authorities, central banks. So I think when you look at that, there is a movement right now to start looking at diversifying portfolios away from just strict held dollars. I mean, the Chinese have about 72% of their money in dollars right now, and I think they're going to look at other things. I think they're going to look at oil. I think they're going to look at many other commodities that I think have a well-defined place right now in every portfolio.
Historically, Frank, we do see an inverse relationship between gold and the dollar, right? I mean, what if, does that still stand today as far as you can tell?
It does, and it's about 80% of the time. 20% of the time they go in the same direction. And in fact, earlier this year, and I was on Kudlow's program in April, we went to 38% cash in our gold funds because we were concerned about the degree of the dollar decline relative to the rise in the price of gold. Presently, we still have a healthy cash position, nothing compared to last April. So we remain modestly bullish on the price of gold over the next 12 months.
Craig, how about you? Give us the bottom line. Are you modestly bullish? What are you forecasting for a price?
Yeah, I'm right along the lines of Frank. I mean, his fund at U.S. Global has been phenomenal in their performance. His calls have been right on the money. I think I might be a tinge more bullish than Frank in so much as that I think we're going to touch back to that old 725 high and maybe test 750 by the year's end. But I think 2007 is going to be a very good year for the commodities because I think the dollar is going to go back and retest those lows of the 1992 era. I see nothing that will support this dollar given the future we have ahead of us with the change of leadership in Washington and many other factors.
I got to end it there with the one caveat that that's what a lot of folks were saying at the beginning of the year. So
and Michelle,
let's see if 2007. You get the last word. 10 seconds, Frank. We got to go.
As for gift shopping, it's holiday season time. I think it's a great time to look to buy gold, simple gold coins for gifts for kids.
Okay.
And gold jewelry for you.
Oh. Flattery will get you everywhere, gentlemen. Craig and Frank, good to see you.
Good being with you.
Okay, I know what to get you now, right?